So right now, today, June 5, 2026, Wall Street's most sophisticated trading algorithms are just having a complete meltdown.
It is absolute chaos out there.
It's hilarious, honestly.
Yeah.
So a massive $1.68 billion initial public offering just closed on the NASDAQ. It's for this quantum computing company backed by heavyweights like Honeywell and JP Morgan.
Right. The company's called Quantinuum.
Exactly. And their chosen stock ticker, QNT, which is a huge problem.
Yeah, because that is the exact same ticker symbol as a billion-dollar blockchain infrastructure project that's been trading in the crypto markets for years now.
And so you have these quantitative trading bots that just parse headlines and social media sentiment all day, right?
Exactly. They're scraping the web for breaking news about high-performance quantum computing so they can execute these rapid-fire equities trades.
But they are violently colliding with data feeds about decentralized blockchain tokens. It's just this incredible case of mistaken identity.
The bots are totally confused.
Yeah.
And the broader market is so distracted by this NASDAQ glitch that they are completely missing the actual story.
Right. Because while the algos are tripping over this ticker confusion, the actual crypto QNT Quant Network is quietly rewiring the underlying plumbing of the global financial system.
It's a massive architectural shift happening right in the background.
And that shift is exactly the mission of today's deep dive. We are looking at this huge stack of sources, market reports, technical white papers, news releases,
all detailing Quant Network's transition from what was essentially a speculative crypto project into its real enterprise production phase.
Yeah. We are going to break down their brand new Layer 2.5 technology, unpack their integration into a massive legacy finance titan called Murex, and figure out why forecasting algorithms are completely at war over what this token is actually worth.
It's a lot to cover.
It is. Okay, let's unpack this. To really grasp the sheer scale of what's happening with traditional banks, we have to look at the technology Quant just deployed.
Right, they just pushed this to mainnet, which is the live production environment.
Exactly, 3 days ago, on June 2, 2026.
Which was actually Quant's 10th anniversary. Their founder, Gilbert Verdian, officially launched the Fusion Rollup.
Now, the sources keep referring to this Fusion Rollup as a, quote, Layer 2.5 multi-ledger rollup. And I want to break down what that actually means because, you know, the crypto industry just loves throwing around jargon.
Oh, they absolutely do. It can be impenetrable.
So from my understanding, a standard Layer 2 rollup, like the ones we see built on top of Ethereum, it acts a lot like a bartender running a tab.
That's a great way to think about it.
Right. Like instead of charging your credit card for every single drink you buy throughout the night, the bartender groups all your orders together off-chain.
And then they just process one final transaction at the end of the night.
Exactly. It saves everyone massive transaction fees. But the catch is that a standard rollup only settles that tab on one specific blockchain, like Ethereum.
Right. But the Fusion Rollup takes that exact same concept and scales it horizontally.
Wait, horizontally? Meaning what exactly?
Meaning instead of settling the final receipt on a single ledger, this Layer 2.5 environment settles the tab across 74 different blockchains simultaneously.
Wow. 74?
Yeah. It natively connects public networks like Ethereum, Bitcoin, Solana, the XRP ledger, alongside private permission ledgers that enterprises use, like Hyperledger Fabric and R3 Corda.
Trying to picture how a global bank interacts with 74 different networks, it honestly made me think of an international travel adapter.
Okay, I like that analogy.
Because before this, if a financial institution wanted to move liquidity around the digital asset landscape, dealing with 7 different blockchains was like visiting 7 different countries.
You needed 7 different physical plugs.
Like 7 different physical plugs, 7 totally different compliance checks, and trying to move the electricity or liquidity between them was just an absolute nightmare of fragmentation.
And expanding on that travel adapter analogy is really crucial here because the Fusion Rollup doesn't just change the physical shape of the plug.
Oh, it does more than that.
Yeah, it has a built-in transformer. It programmatically translates the smart contract language of a public chain directly into the specific compliance language required by a private banking ledger.
And it does that natively.
Entirely natively.
Which leads right into what the Quant white papers call their unified asset model. Because instead of a major institution dealing with, 7 incompatible copies of a digital asset,
like a USDC stablecoin or BlackRock's BUIDL fund scattered everywhere.
Exactly. Instead of that fragmented mess, Fusion collapses them. It creates a single canonical instrument, like a USDC.
So the bank just gets one universal balance sheet.
Which is huge for accounting. And The security implications of this native translation are pretty profound, right?
Oh, absolutely. By connecting directly to the underlying ledgers through this layer 2.5 setup, Quant completely eliminates the need for cross-chain bridges.
And cross-chain bridges have been the absolute bane of the crypto industry for years.
They really have been.
The sources estimate that billions of dollars have been stolen through bridge hacks over just the last 5 years alone.
Because traditional cross-chain bridges function as these massive, incredibly vulnerable honeypots.
Mechanically, how does a bridge actually work, just so we have the context?
Well, a bridge requires you to lock up your real assets in a smart contract on one blockchain, and then it issues you an artificial wrapped copy of that asset on the destination blockchain.
So the hackers aren't even attacking the blockchain itself.
No, they simply look for flaws in the smart contract holding all those locked assets.
I see.
Once they drain the original vault, the artificial copies on the other side instantly drop to zero value.
That is terrifying for a bank. So by removing the bridge entirely and just routing verified instructions natively, Quant removes that structural risk.
Exactly. It removes the exact vulnerability that has kept Wall Street terrified of utilizing public blockchains.
Okay, so they've built this flawless, highly secure, universal adapter with a built-in language transformer. The tech is genuinely impressive.
It's a huge engineering feat.
But I mean, if I'm the chief technology officer at a legacy bank, I am not known for my agility, right?
Definitely not. Banks move notoriously slow.
So I am not going to scrap a 40-year-old mainframe system, fire my entire risk management team, and try to retrain thousands of employees to figure out Web3 browser wallets.
And that right there is the exact friction point that kills most blockchain startups.
Right. They build this utopian tech and just expect the legacy world to adapt to it.
But Quant's strategy takes the complete opposite approach. They are embedding themselves silently inside the legacy infrastructure that these banks refuse to abandon.
And that brings us to this massive Murex partnership that was finalized back in March 2026.
Murex is an absolute titan in the world of traditional finance.
Yeah, the sources say their MX.3 platform is basically the software that runs trading desks, risk engines, and post-trade operations for global capital markets.
It's essentially the central nervous system for institutional trading.
The numbers are staggering. It's used by over 300 major financial institutions, with 60,000 daily users across 65 different countries.
And to understand why Quant integrated directly into MX.3, we have to look at what's called the operationalization gap.
Right, because tokenization of real-world assets, things like digital bonds, treasury bills, commercial paper, that market just crossed the $100 billion mark.
The banks clearly want the efficiency of digital assets. They want instant settlement.
But they've spent decades building these rigorous risk management and compliance frameworks to satisfy government regulators.
Exactly. They simply cannot compromise their entire risk infrastructure just to trade a tokenized bond.
So Quant bridges that gap by acting as an optional software connector directly inside the MX.3 system.
And the specific mechanics of this connector are what make it work for regulators.
Yeah, it provides automated pre-trade and post-trade compliance checks across all 74 of those blockchains we talked about. But it deliberately refuses to take custody of the actual cryptography.
Right. Quant leaves the storage of the digital assets to specialized custodians. They are acting merely as a routing engine for verified instructions.
Which is smart, because regulators absolutely require that separation of duties.
100%. A routing software cannot also be the vault holding the funds.
And speaking of regulators, the regional landscape is actually dictating how quickly these banks are turning this software connector on.
Yeah, Europe is currently leading global adoption by a wide margin.
Because their MiCA regulations provided the legal clarity banks needed to finally move from testing into live production, right?
Exactly. Well, the United States seems to still be dragging its feet on broader asset tokenization.
Yeah, the U.S. is definitely trailing on complex tokenized securities, though the sources mention the recent passage of the Genius Act has spurred some movement.
Mostly specifically regarding stablecoins used for settlement, yeah. But meanwhile, the APAC region is moving incredibly fast.
Right, operating under agile regulators like Singapore's Monetary Authority. But hold on, I have to push back on this whole TradFi meets DeFi setup for a second.
Okay, what's the issue?
When you look at how this integration actually functions on a trader's screen,
Yeah.
I mean, it feels deeply contradictory.
How so?
Well, you have a digital bond settling instantly at T0 on a blockchain, being managed in the exact same software window as a traditional bond that takes 2 full days to settle at T+2.
Yeah, side by side.
Isn't that like putting a cutting-edge smartphone operating system inside a 1980s rotary phone? It just seems incredibly clunky to force Web3 assets into a legacy interface built for analog settlement.
From a pure software engineering perspective, I mean, you're not wrong. It does seem counterintuitive.
Right. The instinct is to just build a brand new, purely digital platform.
But standalone digital asset platforms ultimately fail within large banks. And they fail because they fracture the bank's daily operations.
So a trader would have to, check two different screens?
Yes, run two different liquidity models and then try to reconcile two completely separate risk profiles at the end of every single day.
Okay, yeah. The operational cost of that fragmentation at an institutional scale would be devastating.
Exactly. As the Murex executives explicitly stated in the source documents, making what already works programmable is the only realistic way institutions will ever adopt distributed ledger tech.
So the bank treats a digital bond and a traditional bond as the exact same financial instrument for risk purposes.
Yep. The only thing that changes is the invisible rail used for the final settlement.
They are literally sneaking the blockchain revolution in through the back door of the software these banks already boot up every morning.
It's a total Trojan horse approach to adoption.
But, okay, if 300 massive institutions have access to this 74-chain rollup through Murex, how does that actually translate into value for the underlying QNT token?
That is the big question.
Because if JP Morgan's executing trades through MX.3, they definitely aren't logging on to a retail crypto exchange to buy QNT tokens to cover the network fees.
No, absolutely not. And that assumption brings us directly into the tokenomics, the underlying economic engine of the network.
There seems to be a massive misconception about how utility tokens actually function in enterprise B2B software.
There really is. Let's look at the baseline numbers first to set the stage.
Okay, so the market snapshot from the sources shows QNT currently trading in the mid-$60 range.
Covering right around a $1 billion market cap.
But back in September 2021, driven by all that retail euphoria, it hit an all-time high of over $427.
And on the flip side, its all-time low was roughly 21 cents.
So we have an asset sitting in a highly compressed middle ground right now.
And that price compression makes perfect sense when you map out the actual utility mechanics. Like you deduced, enterprises do not interact with the token directly.
Right, because it would be an accounting nightmare for a global bank to hold a volatile cryptocurrency on their balance sheet just to pay for software routing.
Exactly. Instead, they pay their licensing and transaction fees to Quant entirely in traditional fiat currency.
So dollars, euros, pounds.
Yes. So there has to be a silent conversion happening in the background that the bank never even sees.
They pay in fiat, but the network requires QNT to operate.
That is exactly it. The Overledger operating system programmatically takes that fiat currency and purchases QNT on the open market behind the scenes.
Oh, wow.
And this is the crucial mechanism for the token's value. Those newly purchased QNT tokens are immediately locked up in smart contracts.
Locked up for how long?
For the entire duration of the enterprise's software agreement. So they are effectively removed from the circulating supply.
And the sources heavily emphasize that QNT has a strictly capped maximum supply.
Very strictly capped. There will never be more than 14.8 million tokens in existence.
And right now there are roughly 12 million circulating in the public markets.
So it acts as a fixed supply asset functioning as a software license.
Meaning the more institutions that use the network, the more tokens are programmatically bought and locked in enterprise escrows.
Exactly, which constantly shrinks the available supply for the open market.
But wait, this reveals a massive disconnect to me.
How so?
Well, Quant has the Fusion Rollup live on mainnet, connecting 74 blockchains. They were integrated into Murex. They're powering the Bank of England's synchronization lab.
They're running tokenized sterling deposits in the UK. Yeah.
Right. So with all this live enterprise utility, why is the token price floating sideways in the 60s today when it was over $400 years ago, based on nothing but white papers and pure hype?
It's because we are witnessing the painful maturation phase of financial technology.
The shift from speculative retail premium to actual transactional utility.
Precisely. During the hype phase, retail investors drive up the price based entirely on the promise of future adoption. But then we hit that operationalization gap.
Because it takes a bank years to go from a successful pilot in a regulatory sandbox to a live production environment.
Yeah, moving billions of dollars of real commercial paper takes years of auditing, risk assessments, and compliance sign-off.
So right now, in the summer of 2026, the actual institutional transaction volume just isn't high enough yet.
Right. The rate at which those QNT tokens are being locked up by Overledger isn't moving the needle enough.
The background fiat to token conversion isn't buying up enough supply to offset the sell pressure from all those early retail investors.
The ones who bought during the 2021 hype phase and have finally just lost patience.
Wow, so the structural demand sink is fully functional and live.
Yes, but the sheer volume of enterprise usage hasn't tipped the scales yet to overpower the retail supply liquidating on the open markets.
In that tension between institutional onboarding and retail impatience, that totally explains why the forecasting models for QNT are wildly chaotic right now.
They are completely all over the place. We extracted predictive data from several different analytical platforms for this deep dive, and they are essentially at war with each other over how to value this asset.
The divergence in these models really highlights the fundamental identity crisis of the token itself. Analysts literally do not agree on what asset class this belongs in.
No, they don't. Let's break down the three distinct camps we found in the sources.
Okay, first, we have the mean reverting bearish view. Algorithmic engines like Finst see the token hovering right where it is.
Stuck in the $61 to $68 range for the remainder of 2026.
And models utilizing that logic are treating QNT purely as a standard digital asset.
Right. They look at historical charting patterns, they analyze trading volume on crypto exchanges, and they just assume the token will be subjected to the general momentum decay of the broader altcoin market.
They are completely ignoring the enterprise software integration happening behind the scenes.
Entirely. Then you have the middle ground models.
Right. Data pulled from exchanges like Kraken and KuCoin, they project a slow, steady climb, forecasting anywhere from $80 to $280 over the next 3 to 5 years.
Because they are applying a standard compound annual growth rate to their projections.
Which is a very traditional conservative equity valuation approach.
Yeah, you typically apply a compound annual growth rate to a traditional software as a service company.
So applying that metric to a fixed supply digital asset is a fascinating crossover. It assumes moderate, steady enterprise adoption over time.
And finally, we have the hyper-bullish models.
Platforms like Cryptopolitan use a cycle model that expects a parabolic expansion.
They forecast prices rocketing back up to $600, maybe even scaling past $700 by late 2026 or 2027.
Because they assume QNT will just replicate the massive, volatile macro cycles we've historically seen.
Driven by, Bitcoin halvings and global liquidity injections.
It is a remarkable spread. I mean, you have algorithms predicting zero growth, slow, steady software growth, and parabolic crypto expansion all simultaneously.
These highly advanced algorithms are fighting over the valuation because QNT is a mutant asset.
Functionally, inside the Murex MX.3 system, it acts exactly like a boring, stable software license for global banks to route transactions.
But in reality, it trades on the open market like a highly volatile cryptocurrency.
Subject to the emotional whims of retail day traders.
That tension is the defining characteristic of the entire quant narrative right now.
So ultimately, the long-term valuation depends entirely on whether that structural supply sink we detailed actually functions at a massive global scale.
Exactly. Will that pipeline of 40-plus Tier 1 institutions currently onboarding onto the Murex integration actually execute enough transactions?
Will they process enough short-term unsecured debt and settle enough tokenized treasury bonds to meaningfully lock up that rigidly capped supply of 14.8 million tokens?
That is the multi-billion-dollar question that will ultimately settle this algorithmic war.
It really is. We started today looking at a hilarious yet very real ticker collision on the NASDAQ.
Where advanced quantitative trading algorithms literally couldn't tell the difference between a quantum computing stock and a decentralized network token.
But the confusion in the public markets perfectly masks the quiet infrastructure deployment happening beneath the surface.
We looked at the mechanics of the Fusion Rollup, moving past standard Layer 2 ledgers.
Simultaneously settling transactions across 74 different blockchains.
Using a unified asset model to translate the language of Web3 into the strict compliance formats of private banking.
We saw how Quant bypasses the massive vulnerability of cross-chain bridges, and we analyzed the brilliant, if clunky, strategy of sneaking this tech directly into the legacy MX.3 platform.
So banks don't have to alter their existing risk models?
And finally, we unpacked the fierce debate over how to price a mutant asset caught between retail speculation and enterprise utility.
We are observing a profound structural shift here, from speculative crypto projects to critical financial infrastructure.
So what does this deep dive mean for you? It means that the long-promised blockchain revolution isn't going to look like the punk rock disruption that early cypherpunks promised.
No, legacy banks are not going to be burned to the ground and replaced by decentralized applications.
The revolution is not going to be loud. It is going to look like a quiet, invisible software update to the exact same centralized systems those massive banks already use to control global capital.
Which leaves a critical final thought for you to mull over as this transition continues to unfold.
What's that?
Consider the mathematical certainty of the underlying tokenomics. If global institutions seamlessly tokenize trillions of dollars in real-world assets through these legacy portals,
And routing those assets requires automatically, programmatically locking up QNT tokens in enterprise escrows.
what happens to the pricing dynamics of the public crypto markets when the available supply of this utility token quietly, irreversibly dries up inside institutional vaults?
A silent squeeze on a finite asset.
And this
Incredible to think about. Thank you so much for joining us on this deep dive into the underlying plumbing of the new financial system. We will catch you on the next one.